Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be answering a viewer subscriber question that was asked here on the channel just earlier today. I want to make a quick video going over this specific question because I believe it's a question that many investors ask when they're beginning their investment journey. So I believe there is no right or wrong answer to this specific question because it does vary by individual to individual. So with that said, if you are brand new to the channel, have not yet subscribed, hit that subscribe button below. If you do enjoy this video, find it helpful, hit that thumbs up. And if you have any comments, questions at all, drop them in the comment section below. I will read and reply to all your comments. If it's something just specific to you, I'll just normally reply back to you. But if I believe it's a question that'll benefit the whole viewership, the channel, then I will go ahead and create a video covering that specific question, and we'll go ahead and answer it. If you guys would like to chip in also in the comment section to this specific question so that the viewer, the subscriber, the commenter can have multiple answers, because this question is pretty much, there's no right or wrong answer to this specific question. So I'm going to go ahead and flip my screen around here, and we're going to go ahead and answer the question, or just read out the question that was asked. So would you say that funding an M1 Finance account with $10,000 is too much to start off with? I'm looking to use the auto invest feature, but I have been holding off on funding the account until I decided on a specific amount. I just didn't want to rush into anything and make an irresponsible decision, but this is money that would be sitting around in a high yield savings account, so I'm willing to invest it. Just looking to get your thoughts since this is my first foray into investing. So right off the bat, I want to take a few seconds here to just congratulate the individual here because he wants to begin his investment journey. That is a hard step, to just put cash into a specific account that you're not going to be spending. That's a big, a lot of people don't think individually that it's a hard move to overcome, but when you're taking cash and you're setting it aside, you're making a mental decision to take cash, and you're not going to be spending it. You're going to be setting it to the side. You're not going to be specifically setting it in a savings account where it's pretty much liquid. You're going to be putting it into the stock market or some sort of investment where it's going to be going up and down in value, and you're going to see red some days, you're going to see green some days. So you're going to get, if you're not used to it all, it could be a little bit emotional at the beginning, but with time that will become over, you'll be able to sort of hopefully overrun it. So the first thing, it really depends on your risk tolerance. If $10,000 is what you want to begin with, but you have liquid equity of $20,000, $30,000, $50,000, then $10,000 beginning your investment journey may not seem like a whole lot to you. But if $10,000 is all you have to your name, you need this sometime in the next 1 to 5 years, then it may not be the best choice to begin dumping the whole $10,000. Now, I would say that in this case, depending on what is your risk level, are you comfortable with leaving your cash in the account for the next 2 to 5 years? Because any recessions can take place anywhere in that time frame, and if there is a recession, you do not want to be pulling your cash out of there because you'd be losing your equity, your initial investment. You want to leave that, especially during those downturns in the market. Once it's already lost equity, you don't lose equity until you completely sell out. Use more equity in order to average down on that position. If it's something within the S&P 500, ticker symbol VOO, that a lot of investors choose to invest to, over the long term, that specific ETF, the index there always goes and continues higher over time. But if you're looking and picking specific stocks, that can be a little bit riskier, as individual stocks do have the potential to lose 5, 10, 15% on earnings, on bad news. So if you're a brand new investor with $50,000, you want to put away 20% of your total net worth and begin investing in the market. $10,000, I would still split that up into multiple pieces in order to get started in the market. And say of $10,000, I would only start with about anywhere between $1,000 to $2,500. Get yourself invested first. Get a feel for that volatility, because you're going to have those red days where you're going to see your portfolio drop by 3%, anywhere from 1 to 3%, even more sometimes. And if you have $10,000 and you drop 3%, that is $300 right out of your portfolio, right out of the gate. It really depends how much liquid cash you have available, what your risk tolerance is. Are you able to continuously dollar cost average? So $10,000, drop it down anywhere between 1 to 2,500. Get yourself invested first. Now you still have cash on the side that now that you've made your initial entry points, you can begin to add cash from your savings, from the liquid investments, to begin dollar cost averaging into your positions that you started your portfolio with, and now you're able to kind of average in as you're getting better deals than you initially had on your specific initial entries. So the auto investment feature on M1 Finance is a great feature. Once you have your portfolio built and set, you can set and forget it. You can go into the funding account, you can go down into the schedule. You can say that, okay, I want to max out $5,000 for the year. You'll go over and set up a schedule. So, for example, the Roth IRA, I have this set up in my account. $6,000 is all I'm able to contribute to the Roth IRA for 2019. So what did I do? I went in there, I did $6,000 divided by 52 weeks. That gave me $115.38 every week that I'm continuously adding to the portfolio in order to dollar cost average weekly. And over the long term, I won't get that initial $6,000 dump at the beginning of the year. I'll just kind of get it spread out, and it'll allow me kind of just dollar cost average throughout the year. And I believe it is good to ask other investors, don't rush into specific things, making irresponsible decisions. But the fact that you're going out there, you're looking to connect with other investors, looking to see the feedback that others have for you. And I think that's a good step. And pretty much that is it. But again, risk tolerance is a big one. If you're going to start investing right now, that's a great opportunity. Always begin your investing journey. The sooner that you begin investing, the better results that you get over the long term. The longer that you have to invest, the more time that you have specifically for your portfolio to compound and build over time. And of course, setting up a schedule and continuously dollar cost averaging will also benefit you. Go over your risk tolerance. Know that once you begin your investing journey, it's not a yearly thing. It's not 1 year, it's not 2 years, it is 5, 10, 15 years you're going to be working on building your portfolio. And you need to have the sort of risk tolerance that when you see red out on the markets and you've made the decision that you've invested in your specific companies, you've picked out that specific exchange traded fund to begin invested in, you need to look at it that is a buying opportunity, that you made the decision already to buy into that specific stock, that company, and that because it fell a certain percentage, don't look at it as a dollar cost loss. Look at it as a price reduction in that specific company that you believe in, that you really enjoy, that you want to have for the long term. So that is basically all I wanted to cover in today's question. Again, if any viewers, subscribers also would like to chime in on this specific question, is $10,000 too much to get started right off the bat? Drop it in the comment section. I think it is a bit high to begin your lump sum into the market, but if you put in anywhere from $1,000 to $2,500, get your initial base, and then set up a schedule that you're able to dollar cost average, just kind of weekly or monthly, invest into that specific in the stock market, then I believe you'll be able to be better off because you'll have liquid cash on the side set aside to take advantage of those dips. Now, back in 2018, when I started my own portfolio over on M1 Finance, I put $5,500 in the account and I was going to fund my pie. I had my pie created. I dumped in $5,500. Guess what happened? M1 Finance Auto Invest feature automatically invested my full $5,500 into my portfolio. So right off the bat, at market highs back on January 8th, 2018, I was fully invested, $5,500 dumped into the market. That was towards 2017 contributions. I then took the remainder of 2018 to add in the additional $5,500 that I was able to contribute for 2018 dollar cost averaging in throughout the year. I made a bunch of videos kind of displaying that. So if you are getting started over on M1 Finance, looking to get started with a Roth IRA, also Make sure that your auto investment feature is turned off when you're putting liquid cash in and you have a portfolio built. Otherwise, it'll automatically buy into your specific portfolio. So that is it. That is, so again, subscribe to the channel if you have not yet subscribed. Hopefully you guys did get some value out of this specific question, out of the answer. Again, there's no right or wrong answer to this specific question. It all depends on the individual. It depends on their current liquid cash. It depends on your risk tolerance. It depends on your time in the market that you want to be invested in for the long term. It's always debatable. This specific question is debatable, and it's up to the individual to come up with a plan for themselves of how much they're able to invest, contribute, still have some on the side, so that if something does have, an accident does take place, then they do have that cash on the side to use for that specific function. So that is it for today's video. Hit that thumbs up, drop a comment, and thank you all for tuning in. I will see you next time. Have a great day. Bye.